I think they will have to revalue gold. It's in their piggy bank. It's for an emergency. They should at least revalue it to spot. Will they revalue it a bit higher? Again, that would be great for America's debt, as Trump Jr. says. But what we're going to go back to my Kissinger warning. If you revalue gold and create a new gold floor in the US and trade it on the COMEX in London at a new price, you have to ask yourself, in the global context, can we just suddenly wake up one afternoon and see this announcement that gold's been revalued? Sure, it's possible. Is it likely? Who am I to say? I would certainly love to see gold revalued as a gold owner. But right now, based on the tone of these reports and the message, it's very hard to determine. It wouldn't surprise me at all if there's a gold revaluation.
Gold's 40% surge from under $2,400 to over $3,400 per ounce in the past year has coincided with the United States' national debt approaching $37 trillion, sparking discussions about unconventional fiscal solutions. Among the most radical proposals gaining attention is the idea of revaluing the government's gold reserves at dramatically higher prices. Macro analyst Matthew Pipenburg has highlighted speculation about revaluing gold to $10,000 to $20,000 per ounce. At $20,000, such a move could generate $5 to $7 trillion in additional government assets, potentially reducing U.S. debt from $37 trillion to $30 trillion and improving economic growth prospects. The concept isn't purely theoretical. On August 1st, the Federal Reserve published Official Reserve Revaluations, the international experience, examining how 5 countries have utilized gains on their gold holdings to raise funds. This research signals the central bank is studying precedents for such extraordinary measures. Piepenburg observes that such developments show the idea of gold revaluation is being taken seriously at the highest levels. Currently, the U.S. Treasury values its 261.5 million ounces of gold at just $42.22 per ounce, a price unchanged since 1973. At this official rate, the reserves are worth $11 billion on Treasury books. At today's market prices, the same gold would be valued at over $750 billion. Crucially, revaluation wouldn't require selling any gold, merely updating its book value. While Piepenburg remains cautious about the likelihood of a sudden revaluation, acknowledging his potential bias as a gold owner, he emphasizes the importance of avoiding sensationalism in such consequential policy discussions. The debate transcends gold itself, reflecting fundamental questions about the architecture of modern finance and how performative it has become. The Fed's research into revaluation mechanics should concern observers, not because it's likely, but because the central bank feels compelled to consider such measures. This video explores how the U.S. may consider revaluing gold as a strategy to reduce its debt. Subscribe for weekly, data-driven insights that inform us of our ongoing market analysis.
Look, I'm a gold bug. I'd love to see gold revalued at a higher price from the bid from the Treasury so the Fed can push gold up. But before we get to that type of fantasy, that type of clickbait of $20,000 gold by fiat, let's look at the reality of these reports. Let's look at the reality of the ramifications. And let's do our best guessing for each of us to determine on our own. I've been thinking about revaluation for years. That was tinfoil hatted in 2020. Francis Hunt was talking about this years ago too. That was tinfoil hatted. To your point, now it's becoming mainstream. Not surprising, it's becoming mainstream because the debt levels have gotten so exponentially worse. And as far as in the issue, I said at the very beginning, to me, revaluation, just like a gold-backed U.S. Treasury, is a sign of, you could say, sounder money, but it's also a sound of desperation. It's a confession that we're in debt. It's a confession that our dollar is distrusted and less valuable. It's a confession that gold is a far more centralized, central and I think critical asset today than it was treated 10 years ago. So these are all very important for the gold camp. But in terms of the reality of a gold revaluation, this report in August, which I just did a Substack discussion on today, and the one that came out in May, this was a May Fed manual. They're both kind of, you could say, telegraphing in a psyop way or planting the seeds of a possible gold revaluation. And let's think about that. Would it work? These are the reasons. When you read this report, it's very sanguine. Ultimately, the mood is it's a temporary fix only, and we're really not in favor of it. It kind of takes away central bank autonomy. But by the way, Lebanon did it, Curacao did it, Germany did it, Italy did it, et cetera. And so these are, South Africa did. These are 5 examples from 1997 to 2024 where countries have revalued their gold reserves to get out of a debt problem. And the question then would be, okay, it's been done. That's them kind of suggesting we're not the only ones going this way. Although I wouldn't, comparing the U.S. to Curacao, St. Martin is kind of sad, or Lebanon is kind of sad. There's a whole other rabbit hole there. But that's how desperate we are. I've said many times we have the balance sheet of a banana republic. But okay, we've got $42.22 certificates. We've got 261 ounces. Some say 287,000, million ounces. If we revalue at the current spot price, that gives us, just shy of 900 billion. Let's say, for simple, good math, obviously, let's say it gives us $1 trillion at the mark-to-market price, which legally on the balance sheet of the Fed and the Treasury, the asset and liability side, that May report says this can be done. So it can be done. And Dissent has said we need to monetize some of our assets at the balance sheet of the Fed. This would obviously be gold. So if we marked gold to market, which is what a Forbes article in February this year said, well, that's $1 trillion. Right. And so again, my point was going to be that's a guppy solution to a whale of a problem. Even Doge, as laudable as it was, despite the problems with Elon Musk and Trump, even if Doge succeeded at its policies, that was still a guppy solution to a whale of a problem. Again, better than nothing. So to your point, what's $1 trillion in this backdrop?
And unless you revalue this higher.
Exactly. And so there's speculation that we could put in a bid for $20,000 gold, $15,000 gold, $10,000 gold, even at 20,000 gold. If you're getting 5 to 7 trillion, that's a significant dent in the debt to GDP. If we went from 37 to 30 trillion by revaluating gold from an act of fiat at the Treasury and the White House, that would definitely get our debt to GDP at a place where you could argue growth is possible. And you could argue that makes sense. That's not desperate. That's common sense. Let's take those $42 certificates and give them something bigger than market. But then you're creating an entirely new floor for the gold price, which for gold bugs like us would be fantastic. I certainly wouldn't. I should be selling that book all day long. But realistically, you've got to go back to Kissinger's warning about revaluing gold, because this is my opinion. It's only my opinion. It's in the face of the World Gold Council. But my opinion is that China and Russia have significantly more ounces of gold than the U.S. does. And that I cannot back other than with other kind of reports I've read from contrarians who looked at these producers of gold, how they report their gold, how they store their gold, how their citizens own their gold. It's my opinion that if we revalue gold to 20,000, that would certainly, or 15,000, again, I'm speculating, no one knows. But if we did revalue gold higher, the adage, he who has the most gold wins, would apply. I think that would certainly help us in the near term with basically using gold as QE, because certainly by monetizing gold and repricing gold, that's better than just creating money out of thin air to pay down our debt like we do at the Fed. If we monetize and revalue gold to pay down our debt, it's 7 trillion or 5 trillion, depending on where we revalued it at, that would be a short-term boon for the US, for sure. That would bring our debt down significantly. But then in terms of our global leverage, and this is what Kissinger warned about many years ago, well, then what is China and Russia with their own exchanges in St. Petersburg and Shanghai? You think they're going to float a gold price at spot today? If we go to 20 or 15,000, they're going to price it more fairly, and they're going to have, I think, more ounces of us and therefore more leverage with their currency and with their trade than us. That's my view. Again, take it or leave it. Some would disagree. But I think the tone right now of these May reports and August reports is it's still, to me, a long shot that they would revalue higher than spot. But on the flip side of that, let's not forget 1930s America under FDR. Overnight, you can make gold confiscatable and then reprice it for the government's benefit. And that happened overnight. Let's not forget 1971, literally 54 years ago this month, when Nixon just got on the phone and said, this is a temporary measure. We're going to decouple from gold. It's going to be very temporary, and your dollar will be worth just as much tomorrow as today. Again, we know that the dollar's lost 98, 99% of its value against gold since that famous lie. But is America under Trump, is this the Nixon America or the FDR America? Can we just suddenly wake up one afternoon and see this announcement that gold's been revalued? Sure, it's possible. Is it likely? Who am I to say? I would certainly love to see gold revalued as a gold owner. But right now, based on the tone of these reports and the message, it's very hard to determine. It wouldn't surprise me at all if there's a gold revaluation. I just wrote 2 articles on it. So I'm taking it seriously, but I've got to hedge my own bias. I've got to hedge my own kind of sensationalism here. None of us really know. Bassett has talked about it. At the very least, I would not be shocked to see gold revalued at spot, at the market, mark to market. But the question is, to your point, Michelle, is that really much of a help? we'll see. And unfortunately, that's all I can say is we'll see.
Matthew Pipenburg predicts that gold will eventually be revalued to at least market value as a key U.S. emergency reserve, but warns that higher revaluations carry significant geopolitical risks. If China and Russia hold more gold than America, as he suspects, a new higher price floor could shift global leverage away from the U.S. Russia's gold strategy validates these concerns. The country's international gold reserves reached a record $248.7 billion in the first half of this year, marking a 27% surge, the highest increase in a decade. This dwarfs the comparable 2016 increase when total volumes were just $63.5 billion. Piepenburg notes that such rapid accumulation shows how major powers are positioning gold as central to their financial resilience. China's approach appears equally strategic. Its gold reserves rose by $1 billion in July to a total of $244 billion, with the central bank purchasing 1.16 million ounces since resuming purchases last November. Crucially, gold accounts for only 7% of China's official reserves, half the global average of 15%. Piepenburg observes that this gap suggests Beijing has significant room to expand its holdings, potentially strengthening its strategic leverage in international markets. The implications are sobering. America's potential solution to its debt crisis could simultaneously hand its primary geopolitical rivals a decisive new advantage, transforming what appears to be a domestic fiscal tool into an inadvertent gift to competitors who have been quietly preparing for precisely this scenario. Let's get back to the interview.
What I was talking about a gold revaluation, or Francis Hunt was 4 years ago, that was crazy. When I was talking about the dollar moving away from the petrodollar, that was crazy. Now that's happening in real time. When I wrote and again, I'm not just saying this, I was not alone in this. Many said this. When we weaponized the dollar in 2022, I said everything's going to change now. Demand for the US dollar, trust in the US dollar, stacking the gold by central banks, the empirical evidence of that, sovereign wealth funds, the decline in the demand for the dollar, the faults in the milkshake theory under Brent Johnson, despite euro dollar and SWIFT and derivative demand, what he's missing is US Treasury demand is going to fail. So all these things happen and gold becomes more and more powerful. I think these theories miss, and what you're saying is very true. The role of gold, whether it's Shelton's US Treasury, gold-backed US Treasury, which has a lot of constitutional law attempts in the past that failed, and we can talk, I've written about that extensively. But the fact that we're talking about a gold-backed US Treasury or even thinking about a gold revaluation to market or higher is the first thing we can all agree on is it shows that gold is now far more central to the conversation of sound money. Bretton Woods 2.0, which Bissett has been talking about for months. Bretton Woods came after World War II after a disaster. I've been saying for years, and again, not alone, that we're going to have, as the IMF projected during the COVID hysteria, they announced a Bretton Woods 2.0. You go to their website, it's literally called Bretton Woods 2.0. And the graph they show, and I can send it to you, literally has gold at the foundation of that new central bank digital currency reaction to the debt crisis, which they blamed exclusively on COVID, but it was entirely the fault of central banks and policymakers and credit issuers. So your first point is, gold is now no longer the fringe, pet rock, kooky asset. And that, again, is regardless of whether you're a gold bug. You could be a Secretary of Treasury and be saying this out loud. You can be the president and saying this out loud. You could be Shelton and saying this out loud. We're going well past the DXY up or down debate, gold inflationary, deflationary debate, gold is a pet rock debate. We're now seeing gold from central banks to private wealth managers, to sovereign wealth funds, to politicians and central bankers talking about gold as central to their thesis. But again, when you look at the report that just came out, to answer your question, will they actually, revalue gold or revalue these certificates? I think they will revalue the certificates to answer your question. Will they revalue 42 to 3,400, 3,500 gold? Or will they revalue it to something where they set a new bid and create a new floor for gold? That is a stretch. That is certainly possible. It's no less likely than Nixon decoupling in 71. So who am I to say? But if you read that report, even the central bankers themselves, because we're worried about their independence, said, if we did that, and they were talking about mark to market, maybe not even going to a higher bid, they said this may not address larger structural issues. And what they're saying is, and this is where I think, I hate to say it, I actually agree with these central bankers, of which I'm no fan. Even if we did a 20,000 floor, which we could, I'm not saying it's impossible, and we got trillions more in QE through gold, and we brought our debt to GDP down, that is still, in their mind, just a temporary fix from these larger structural problems, they call it. And those larger structural problems are still, even if we got massive QE out of gold, revaluing gold, we still were looking at 30 or 35, depending in the next year's spending. We're still only buying a little bit of time before we're right back on that crack addiction to more debt, more deficit spending, which will come from reshoring jobs because we're going to have some short-term pain or shorter, longer-term pain. This is one way to solve that problem. And this is one way, if we have a gold-backed uh, 10-year treasury or a gold-backed treasury option, of bringing gold back into the forefront, paying down some of our debt, and confessing that our dollar and U.S. Treasury is no longer as respected as it was pre-2022. So this is all evidence of the things you and I have been talking about. And you say you're putting me on the spot. I think they will have to revalue gold. It's in their piggy bank. It's for an emergency. They should at least revalue it to spot. Will they revalue it a bit higher? Again, that would be great for America's debt, as Trump Jr. says. But what we're going to go back to my Kissinger warning. If you revalue gold and create a new gold floor in the US and trade it on the COMEX in London at a new price, you have to ask yourself, in the global context, if we're so worried about Russia and China, and that's a personal decision, certainly is on the minds of our central bankers and our policymakers in DC, you have to say, does China really only have a few thousand tons? Does Russia only have a few thousand tons? In other words, or do they have a lot more than the U.S.? We had 9,000 tons in 71. Now we have about 8,000 tons. Is that accurate? They're saying it is. It could be more. It could be less. My opinion, and it's just my opinion, is that Russia and China have more. And so that goes right back to that question. So yes, gold revaluation higher than spot certainly helps our debt, certainly creates new liquidity for a very dry, illiquid market, which is on the teetering of risk, and it would help America in the short term. But be careful what you ask for, because there are other countries that own gold too. And what would England do? What would England's position be after Brown sold all its gold at 270 in 1981? So these are things that are more out there than just these two reports and some quotes online. But, as a gold bug, of course, I'd love to say, absolutely, it's coming. And I'll be happy to see it come. But I can't say with straight confidence that that's a smart decision. I think you can't overstate debt enough. And once you understand just the basic concepts of these debt and the basic math, and it doesn't require a lot more facts, whatever strand you pull on, whether it's currencies, whether it's bond markets, even whether it's foreign policy, and certainly whether it's monetary policy, all of this in the bond market and the stock market, everything does come from the credit market, which is the debt market. So all of these things are connected. All this is verbunden. It's all connected. And again, I go back to these simple things. The day of my birth in the 70s, U.S. debt was 200. Public debt, government debt was 246 billion. And where I am today in my lifetime, we're now at 37 trillion. And that's appalling. And a billion versus a trillion isn't just mathematical and isn't just alphabetical, it's mathematical. As John Rubino reminded me a month or two ago, a billion seconds ago was somewhere around 1997, but a trillion seconds ago was 30,000 BC. So these trillions matter. They're not just abstract numbers you throw out to show what you can memorize. And, global debt, it's not just a U.S. problem. Global debt in 1997, when I started my first hedge fund, was at 30 trillion. And now it's at 300 trillion. That's a hockey puck. It's a rocket ship up and to the right in just the last 25 years. So these aren't things I'm just making up. They're real. And it's not just at the market level or the government level that debt is extreme. Household debt is now 97% debt to income. And so, these are the numbers. And in case you think there's no evidence of how those things break things, you don't have to go back a century. You don't have to go back to FDR. You don't have to go back to 1929. Just in the last 6 to 7 years, it started, and I thought it was completely ignored by the mainstream media and the financial consensus RIA industrial complex. But the 2019 repo crisis was a disaster. It was a credit crisis. It was because of a debt crisis. And just a year later in March, during the COVID hysteria, that was also not a COVID-induced 2020 market plunge. That was a bond market-induced market plunge in 2020 because bonds and stocks fell together in 2020. And just 2 years later, across the pond in the UK, we had the gilt crisis. That was sovereign UK bonds being unloved, undesired, and yield spiking and the cost of debt skyrocketing. The next year in the US, we've already forgotten the headlines. You and I talked about it years back. We had that banking crisis in 2023. 4 of the 5 largest bank failures in US history, forgotten. But that too was not a banking crisis. That was a credit crisis. It was a bond crisis. It was the US treasuries that were the underlying collateral on those banks. And then you fast forward to just this year, Liberation Day, the tariff, event, markets losing 10 trillion and then recovering when Trump did the two-step. But that wasn't a tariff crisis. That was a U.S. Treasury debt crisis, because right after Liberation Day, there were crickets at the U.S. Treasury auctions and massive sell-offs by U.S. owners of U.S. Treasuries, not just Japan and China. So those were all examples of a credit crisis, a debt crisis, and a bond crisis. And they were showing us in real time that we're over our skis in debt. And again, it's not just me finding the evidence. The evidence is all around if you're willing to look for it. And in this debt crisis, we have very few options. We can default, which we won't do. So we'll have to inflate away our debt. And the way we do that is dishonest. Inflating away debt just means you have to have an inflation rate higher than your yield on your 10-year. And so you have negative real rates. That's the fancy term. You just have to inflate away your debt. You debase your currency to do that. But the way we do that so dishonestly and disingenuously is we lie about the inflation rate. We just do. The BLS is a fiction source, not an honest math source. And the CPI scale used to measure that inflation scale has been, changed 22 times since 1980. It's probably closer to 10%. So we're running negative real rates. We're running a debased currency policy. We're running an invisible tax on the people, lower, middle to upper class, to basically pay our debt by debasing the dollar, as von Mises, as David Hume, as even Ernest Hemingway warned, who weren't, all in the same generation. This is Ima vida das gleica, are always the same. And I think this debt is so powerful that as we talk about stable coins, or we talk about the markets, or we talk about tariffs, or any of these topics that are making current headlines, they're as old as history itself. We're in a desperate state because we're running out of options. And when you get to a debt to GDP level at World War II levels with no war, the emergency isn't war. The emergency is our own overspending and the mismanagement and criminal negligence of our monetary policymakers and our leadership, left or right, because all of these nations and all of these policies and all of these parties, whether it's Democrat or Republican, to me are just two stirrups to the same saddle. They spend more than they can to get short-term dopamine rush for political reasons, not for longer-term thinking.
Gold is increasingly becoming the centerpiece of national reserve strategies, with major economies steadily expanding their holdings to strengthen financial security, diversify assets, and reduce dependence on the U.S. dollar. This accelerating accumulation reflects a broader recognition of gold's enduring value, not only as a reliable hedge against inflation, currency risk, and market volatility, but also as a powerful instrument of geopolitical influence. As central banks intensify their purchases and integrate gold more deeply into their long-term monetary planning, the trend signals the potential for profound and lasting shifts in the global financial balance of power in the years ahead. Stay tuned for more data-driven insights into the evolving financial landscape. If you value precise, fact-based analysis, be sure to like and subscribe so you never miss our weekly updates. I appreciate your support and enjoy the video.